Hi everyone, this is Paul Cooper, the host of the Take Note podcast, and on this episode we're going to continue our adventure from last time and we're going to examine a little bit more of the I-25 corridor here in Colorado. And so our next city that we're going to cover today is Denver, and we're going to do the city of Denver, the metro area, and just see what we can see about what's going on with the city, its growth, if there are any places that are even affordable to really invest in, and kind of look around and see what we can find, and continue on from our last episode where we examined Colorado Springs. I had a lot of requests to cover more cities, so we're going to do Denver since that's also a really hot market. In the future, I'd love to have suggestions on other markets you'd like us to cover. And I'm also currently looking for realtors in these cities. That way we can have them come on and give you more of a local opinion as opposed to just my opinion. We can get a real estate professional that's currently involved in the area, whether it's buying, selling, or just listing properties for other people. And that should help us confirm any insights we're able to get from this raw data and maybe help us narrow down better places, or something may look good with the raw data, but then they can tell you, hey, the schools there suck, or, hey, this is being built or that's being built, that will either make it, better or worse. But anyways, let's get to it. So here's a little bird's eye view of Denver. It's a gigantic city if you haven't already been there. Not nearly as big as LA, but it's well on its way. Now let's get into the raw data. Again, we're on citydata.com. You can just Google city data and it'll bring you here, and then you can type in whatever city you're looking for. Sometimes it takes a minute or two to load up. It just depends, one, on your internet connection, and then two, on the website. Sometimes it's a little slow. So we'll go ahead and bring up our Excel spreadsheet here. I've been working on a copy, so you all will eventually be able to download this and input your data, and then it'll automatically change colors and give you suggestions according to these guidelines and rules on whether it would be a good area or not to invest in. I'll try to have it done by Labor Day, if not before then. So keep an eye out for that. So rule for number one for this city is the population growth, because population growth will really help decide the direction that the city's going in, whether it's expanding, contracting, and let you know if it's really worth even messing with. So if we look here, we're at about a 27% population growth over 17 years. That's good. So we'll plug that in, 27%, greenlit for us. And if you would just want to see a brief example of how it works, you can put in 18%, and that's below what we're looking for, but still probably okay. And then you put in something even lower, then it can go red. So I've got that in for you all, so you can just have a quick decision. Again, the rules are right here, but it'll be really easy to know at a quick glance whether you should continue messing with it or not. So the next stat we're looking for is the median household income. And as you can see here, it was $39,500 in 2000. In 2017, it's $65,224, which gives us a 65% increase. So that's definitely good. The next focus is the median housing value growth. So let's look at that. As you can see, from 2000 to 2017, it went from 160 up to almost 400,000. So that's good. Gives us roughly 147% increase. All right, so the next stat we want to look for is the crime number. And remember, we want that to be around 500 or lower. And if it's not at 500, but you can look at the past and see that it's declining, then that may be a very good indication that it's still a good place to invest, even if the crime is relatively high. Remember, you got to scroll all the way down for the crime number, and here it is. And this is the total number that we're looking for. So if we're going to look from 2005, it was just a little over, not quite 6, and it's slowly been decreasing down. It looks like 2008 was a really good year, then popped back up, but it looks like it's going to settle in the low 400s, which is good. So we'll put 430. We'll just go ahead and round up to 432. Now, the last thing for the city guidelines we want to look at is the job growth for the last 12 months, and we can get that from the Department of Numbers. Now, remember, though, with COVID going on everywhere, even strong cities like Colorado Springs, Denver, and other cities that are having good economic times have had a lot of unemployment and people losing their jobs this year because of COVID. So, again, if these numbers look good, I would say this number's really kind of irrelevant as long as it's not bottom of the barrel in the list. And again, we're going to go to the Department of Numbers. That's different than city data. And now we're at the Department of Numbers. And again, you can just Google Department of Numbers and it'll bring it up for you. And so you could go through this list, or we could just do Control F and find Denver. So Denver, Colorado, 2.39. 103,400 and 6.74. So we'll go back up. So that's jobs present change. So June was good. Jobs added for the year was negative, and the job percentage change for the year was negative. So what this tells us is looks like June, they gained a few jobs, but overall this year they've lost over 100,000 jobs, and they're still down 6.74%. So in the scheme of things, that's not terrible considering how bad things have been for people, and we still have anywhere from 30 million to 50 million people unemployed, depending on what numbers you get and from where. That's relatively, compared to everything else, that's pretty good. So we'll go ahead and plug that in, and even though that's negative, I would say with everything else being green, that the city indicates it would be a good city to invest in. So now here comes the hard part is, Denver's just a gigantic metro. And so we have to kind of figure out what neighborhoods we want to invest in. And this can be really hard in a large city, even if you know the city. And it's going to be even harder if you don't know the city. I'm not super familiar with Denver. I don't spend that much time up there. And even less now that my family that was there has kind of moved to Kansas City in Florida. Or I've never been too familiar with the neighborhoods. Like I know Cherry Creek, where my aunt and uncle used to live, is a really nice, trendy, rich area. And then, some of the other suburb areas like Aurora are nice. But as far as Denver proper, I couldn't name you that many neighborhoods. And so this could be a little bit harder because we're going to have a lot of data to sift through. All right, so just above the crime number is a map, and we can change this through the settings to kind of get a heat map of the different, and this is based off the median household income. I kind of like this warmer color, but you choose whatever you like. And so if we look here, the light yellow is going to be less, and then the orange is in the middle, and then the red is going to be the higher income areas. So just looking from here, we can see the Inglewood area's got a nice big affluent patch. We can see in the center right here is pretty decent. And then Centennial, Centennial's a really nice kind of suburb with some nice homes that a lot of people are living in. And but you can just see all the different suburbs that are part of the great metro area. Broomfield's a pretty nice area. I know that because a Rocky Mountain Metro Airport's there, and it's a pretty affluent area. And then we've got some areas out towards the mountains that start getting pretty nice as well. But overall, Denver's an expensive city, so you kind of have to have money to get by there. But we'll go ahead and we'll choose this neighborhood here. And again, it only gives the census block group, gives the breakdown. I'm not really sure what neighborhood this is. But if we look at it here, the median household income is $219,000. The median house or condo value is $1 million. So you can tell right here that this probably isn't going to work as a rental. Because if we go back and look at our rules, we're looking for median rents of $700 to $1,000 and median household incomes that are significantly lower. So these homes are going to be significantly more expensive. Probably not going to get this as a rental area unless you just can work out some type of B&B for the area, an Airbnb or something else. It's just not going to make sense to probably pursue this too much further as a rental market, or even if you did an appreciation play, you'd be on the very high end with $1 million home. And so you would then have to start thinking about how much risk are you taking to buy, wrap up $1 million or just the down payment of, $200,000 plus having to pay insurance on it, plus having to maintain it and the taxes and everything. How much appreciation do you need to have over that holding period for you to actually make money? And that's an expensive home. So let's look at some of these other areas here. So this area here, a little bit cheaper, but not too much. Other areas about the same as the first. So why don't we look at some of these orange areas that are surrounding these really nice areas just to see what we can get there. All right, it's coming down a little bit, but this $145,000 is still, double our $70,000 limit here. Because we're looking, if you just want rentals, we're looking for medium household incomes between $40,000 to $70,000. If you want the appreciation play, then $55,000 to $90,000. So this is still above even the appreciation play. So these are still a little bit higher end according to these guidelines. That doesn't mean that it necessarily wouldn't work. It's just you would need to do more research, and according to these guidelines and rules that we've been following, that apply to most of the U.S. If you can get these to work, then you should be good to go. So let's try these yellow areas here. Here we go. So that's $52,000 for household median income. That makes sense. The rent is a little bit on the high side at almost $1,300, and we're looking at about $1,000 max. I would still say that we could look at this further, because in a lot of large metro cities that are expensive, $1,300 rent for a small place is not unheard of. It's actually pretty common and probably not a bad deal. Now, the house value is still pretty high at $220, and then the house value of $220,000 isn't terrible as well. You may have a hard time getting this to rent well without putting down a large down payment, or if you can find a home that needs to be rehabbed and put in a little sweat equity, it may work. And so what we'll do here is we'll plug it into our time value money calculator that you can get to online, which is just fncalculator.com. So we'll say a home value of $221, future value of 0 because we're going to pay off the whole thing. Annual rate, rates just depend right now on your credit and everything. If you can get something approved, they're pretty low. We'll say 3.5 because that seems to be pretty standard for people with good credit. And we'll put in 360 payments, which would be a 30-year. So let's see what our payment comes out to. So our payment comes out to just under $1,000 a month, and that doesn't include taxes or insurance. And let's go back. I believe the rent was $1,300. So yeah, the rent's $1,300. So honestly, by the time you pay for the taxes and insurance, you're probably going to be paying $1,300 for that. Now, granted, we did our calculations without a down payment. So if we go back and we do the down payment, let's see what that is. So that would reduce our mortgage balance to $176,800. And then that brings our payment down to just under $800, which is significantly more doable. So let's say we're able to get $1,300 for the rent minus $800 for the monthly payment. And then you're probably going to need to subtract at least $200 more for taxes and insurance. In fact, let's make it at least $250 just to be on the safe side. So really, before capital expenditure, maintenance, and everything else, best case scenario, you're only going to make about $250 a month off of that home. And that's assuming that we're getting the home that's good to go for $221, and we're able to get the $1,300 market rent. So if you can see there, that's pretty tight for a rental. That being said, an appreciation play here might be safe. So depending on the neighborhood, and if you think that the city's going to continue to grow, which I absolutely think Denver's going to grow. It's been one of the fastest growing, if not the fastest growing major metro in the United States for several years. West Coasters are flocking here like crazy. Other people that, from the middle of the country are flocking here because they want to get away from just empty plains and wind and be nice to see some mountains. And there's just a lot of companies here with good jobs. So there's been a lot of people moving to the Denver area. And I don't think that's going to stop anytime soon, short of a natural disaster. So an appreciation play here might actually make sense, and it might actually be fairly safe. And so you would want to really dig in and learn more about this neighborhood to make sure that people are going to continue to move there and that the price is going to go up. Now, what we do know is that the surrounding neighborhoods are nicer than this neighborhood that we're looking at. And that's usually a good sign, because as these homes increase in value, it should only bring this neighborhood up, assuming this neighborhood doesn't basically go or something bad happens. So that's a good sign. And the median household incomes aren't super high. The house value isn't super high compared to the national average, but to me it's roughly 4.5 times the median household income. That's a little high to me, but the unemployment looks good, and residents below the poverty level, that's one of our other things we're going to look at here in a second, and that looks good. So let's go ahead and fill out the rest of this. Now remember, when you're looking up the city's unemployment rate, it's usually easier just to Google it, and so we're looking at 12.1% because the Department of Numbers just shows you the change. It doesn't actually show you the rate, the current rate. All right, so I've plugged in all of our numbers here for the neighborhood. So The median household income indicates that it'd be a good rental. The median rent is a little high, not super extreme. You'd want to do a little bit more research, but I think for Denver, that's probably fine. And then if you look at the unemployment rate, we're 5.36% for the neighborhood. The city's at roughly 12%. And so that's a 6% difference there. And that's good to go. We don't want it higher than the city's unemployment rate by much more than 2%. And it's well below it. So that's good. The poverty rate, I was kind of surprised that it was at 17.4%, which is still well under the 20% rule. And we'd like it to be under 15%. But with this number still being in the range and the unemployment rate being what it is, I think that's fine. And so now comes the ethnic mix, and we talked about that in the last episode, and it's kind of just up in the air on how important it is to you and how much it really matters financially. If we look here, I mean, this neighborhood's mainly white. There's a second, piece here that's Hispanic at 7.3%, and then looks like there's a small group of Asian, and then other. So, I mean, there is some diversity in this neighborhood, but I'd say it's pretty white. Again, it's hard to tell how important of an impact, if any, that actually has on you and your investments. But it's good to know, and you can actually look down here at the races and demographics in Denver. So if you can look here, the city of Denver is just a little bit over half white. Then there's a large Hispanic population, and then there's several other groups of minorities here. So Denver is actually a fairly diverse city in that regard, and so that's nice. Again, it's hard to tell from a financial standpoint how important that is or isn't to your investments, but it's just nice to see. Now, if we zoom out here, there's some other areas that I would probably look at to see if they're worth investing in or not. So what I would do, knowing very little about Denver, or if there was any other city where I had very little idea about the neighborhoods, I would look at areas that have high incomes, and then I would look at the neighborhoods surrounding them like we just did. We found this one here. This one over here might be a good one that's a little bit higher priced. But these over here might be good. And then if we zoom out, we've got these cluster of areas here that are a little bit darker in color with some yellow spots around them might be good. Same here. Then out here as well. Then if you want to expand, you could look at an Aurora, which is a nice little suburb. And that would be potentially a good way to start looking at neighborhoods from a really cold analytical standpoint if you knew nothing about the area. Obviously, if you know about the area or you had a good realtor that was investor savvy, I guess really in this case you wouldn't even need them to be investor savvy. You would just need them to help point you to neighborhoods that are in good areas that aren't the most expensive homes in the area, that are more affordable, middle class, and meet these standards. And they could probably pull those up for you, make sure that the crime in those areas is acceptable and that they have good schools. And then if they meet the other standards, then yeah, it's probably wouldn't be a bad idea to start looking for homes there, whether you're looking to do some type of buy and hold for rentals or appreciation play. They may or may not be the best areas for quick fix and flips, but long-term fix and flips, they'd probably be good. So that's just something to think about, and a brief little way that we were able to apply these rules to the Denver area. Now, don't forget, if you haven't already, make sure to go to bit.ly/dumpedon. This is our 2020 portfolio survey. We'd really like it if you take the chance to fill this out. You get a chance to win a bidet attachment from HelloTushy.com, and it should only take a couple minutes. We'll keep all of your information safe. It'll stay in-house. It's not going to be sold to anyone, and you will never have your information personally put out there. These findings will be anonymous. This whole thing will be wrapping up around Memorial Day, and then we'll have the actual findings of it released probably a week or two later. So make sure to fill this out. If you have friends or family that might be interested, make sure to have them do it as well. We'd really appreciate it. I was wrapping up this episode, and something just wasn't quite sitting right with me, that the rent for the area we were looking at was only, $1,200 to $1,300 a month for a house, of all things. If it'd been a small apartment, that would have made sense to me. But for a house rental, that just wasn't quite making sense, especially downtown, because I know downtown, a cheap apartment rental can be almost $2,000. And so I did a little bit more research and sleuthing. And yeah, so we were looking at the area right here. Right, I'm sorry, we're actually looking at the area right here. So the Cherry Creek Shopping Center. So the reason that it was showing the rent there was cheap and the houses were cheap is because there aren't any homes. It's all commercial businesses. It's a shopping center or it's apartments. And so the apartments would bring the price down a little bit on the rent rate because a house would be a lot more. And honestly, I think the numbers from city data probably lag a little bit. And so I looked down here in this area. These are all $800,000 $1 million plus homes. So the rent's going to be like $4,000 there. So that's not going to work. And so I finally came to over here, which correspondingly goes to this spot on our heat map. So this was what we were originally looking at, and now we're over here. And it's showing the median household income's $50,000 and the median house or condo values $341,000. So I went to Google Maps and I just randomly picked a house that looked normal for the area. You know, they seem to be a lot of older starter homes, 3-bedroom, 2-bath. And so then I went to Rentometer, whatever you want to call it, and plugged in the address. And yeah, the average rent for that area is almost $3,000 for a house with 3 bedrooms. That makes a lot more sense to me than what we were getting off of city data. Just that number was way too low and just didn't quite make sense because I knew that the rents in downtown Denver had to have been at least on average about $2,000 for a decent apartment, so that the home should definitely rent more than that. So we did a little bit of sleuthing, and this will come up with you're like, okay, well, if it rents for $3,000 and you can get a home at this price, that's awesome. Well, the house that I was looking at, if you pull up Realtor.com and Trulia and Zillow, they're all saying it's a little over $500,000 for, you know, it looks to be a nice home and everything, but what would be a starter home, 3-bed, 1-bath, just a little over 1,000 square feet. So this illustrates just how stupid expensive some of these major metros can be. And so this here may or may not make sense as a rental, but if you look, at our numbers, on our guidelines, Denver's, at least this area is not even going to come close to making sense as far as the household guidelines. Now, we could run the numbers real quick to see just what it would look like as a rental with actual real numbers. So if we pay $540,000 and it's a 20% down payment, then it's $432,000 for our mortgage. Future value 0, let's say 3.5 for the interest rate, $360. And that gives us a payment of, about $19,500 a month before taxes and insurance. The market rent in that area is roughly $3,000. So that gives us about $1,000 to pay for the insurance, the taxes, maintenance, capital expenditure. So it may or may not be doable depending on how nice the place is and how, if there's any deferred maintenance or capital expenditures. Now, generally, when you're renting a place out for $3,000, you're probably going to have a better type of tenant that's not going to hopefully tear up your place. They're probably going to be more of a professional, and they're probably going to be too busy going to work and to pay for this rent. That's not to say it can't happen. It doesn't mean that you may not get someone in there that makes good money and treats it like garbage and tears it up. But generally, on the nicer side of rentals, especially homes, that's less likely to happen. It doesn't mean it can't happen or it won't happen, but statistically speaking, you're going to have your homes torn up more by low income than higher income. So if you ran your numbers, that could make sense as a rental, and it could make sense as an appreciation play since Denver's growing like crazy and it is a good area of town. It's actually pretty nice. It's near the country club and near the shopping mall and everything. But it's not going to meet these numbers, and you're going to have a lot more money to put out for a single asset as opposed to another city where it may be cheaper. For Denver, these neighborhood guidelines just probably aren't going to work unless you go further out. But that doesn't mean it's not necessarily a bad city to invest in. Because again, look at these numbers. I mean, the growth's great. The wage growth is great. The housing is, insane. The housing value. And it's, honestly, it's probably only going to get worse just because there's so many people moving there. Now, Denver has had a huge amount of multifamily built in the past few years. In fact, it's probably approaching the point of getting overbuilt. And so there's going to be a lot of that coming online. So apartments may suffer as far as rent and everything, but the homes in good established areas, they can't make more of them. I mean, they're surrounded. Those values should not go down again unless there's some type of natural disaster, or something bad happens to the neighborhoods. Because even with a recession, maybe the numbers, well, I say even with a recession, we're in a horrible recession depression right now with all the unemployment and everything. And those numbers are staying pretty steady. They're still making sales. Stuff is slowing down. And it's weird because prices for homes have gone up during this horrible COVID apocalypse that we have. But that's because the interest rates have never been lower, so people can actually afford to get more homes. So right now, if you have a steady job and you have money, you can go buy yourself a home pretty easily because you're going to qualify for good interest rate. And those people that can qualify for these great interest rates can afford more home. So home prices have gone up. It's not the great indicator that you would normally think. You'd think that home prices are going up. That means more people are buying homes and that the economy's good. This way, it's kind of, during the current situation, it's kind of divorced from reality. The prices are going up just because the interest rates to get a big loan are so low. So, Denver, probably still a good place to invest. Definitely need to do more research because it's going to cost you a lot more money to get into a basic investment for a house. But anyways, I just wanted to come back and give you that information because things weren't quite adding up to me, and I just know a little bit about Denver. And people that know more about Denver or large metro areas, it probably wasn't making sense that the rent was $1,300 a month and that those home prices were there. So I think city data lags in a few departments. And that's the thing. If you don't know the town and you don't investigate more, then we were trying to make values and investment decisions off an area that really doesn't have any homes. So that wasn't going to work. This was just a good illustration of how to apply these rules and look at some of the cold hard data. And then what you should do to follow up. Use Google Earth, use Rent-A-Meter, other assets like Trulia at Realtor.com to kind of get what the actual rent prices are and the actual values of the home. But anyways, I hope that casts a little bit more light on what's going on there. If you have any questions about this episode, or you'd like us to focus on anything, or a different city you'd like us to cover, don't hesitate to reach out. We'll be bringing more videos to you soon, and we really appreciate you tuning in.